Hello and welcome back to the channel, your go-to source for demystifying complex financial markets. Today, we're diving deep into the fascinating world of hard-to-borrow stocks and potential short squeezes, and we're doing it with a real-world example straight from our screener, GITS. We're going to break down exactly what makes a stock hard to borrow, why the costs can skyrocket, and what all of this means for potential short squeeze scenario, specifically looking at GITS. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's zoom in on GITS, a micro-cap company that recently flagged our hard-to-borrow screener. When we look at GITS, several numbers immediately jump out, painting a picture of a stock under specific market pressures. The most striking figure is its annualized cost to borrow, or CTB, which stands at an astonishing 932.3%. That means theoretically short sellers are paying almost 10 times the stock's value just to hold their short positions for a year. The estimated float for GITS is quite small, at 2.4 million shares. Our internal composite squeeze score, which factors in CTB, bar supply, float, and momentum, currently sits at 42.5 out of 100 for GITS. Looking at recent price action, GITS has seen plus 0.0% today, plus 0.0% over the last 5 days, and plus 0.0% over the last 30 days. And critically, today's volume is 0 shares, with a 30-day average volume of 0 shares, meaning its relative volume is 0x average. This lack of trading activity is a very important detail we'll come back to. Show GITS data on screen. What is cost to borrow and why it matters? So, what exactly is cost to borrow and why is it so important when we talk about short squeezes? Simply put, the cost to borrow is the fee that short sellers pay to borrow shares of a stock from brokers. They borrow these shares to sell them, hoping to buy them back later at a lower price and profit from the difference. This fee is typically expressed as an annualized percentage. When a stock CTB starts to climb, like GITS' eye-watering 932.3%, it's a strong signal. It tells us that there's extremely high demand to short the stock, and for a very limited supply of shares available for borrowing. Think of it like a rental car. If everyone wants to rent a specific model and there are very few available, the rental price goes way up. Similarly, if many investors want to bet against a stock and few shares are willing to lend out, the cost to borrow those shares skyrockets. A CTB can exceed 100% because it's an annualized rate, meaning a daily fee that, if sustained for a year, adds up significantly. Why this stock is hard to borrow right now? For GITS, that 932.3% CTB tells us it's incredibly expensive to short this stock right now. This is primarily driven by what appears to be a scarcity of shares available for shorting, despite the exact number being unknown to us. The estimated float of just 2.4 million shares for GITS certainly plays a role here. With such a relatively small number of shares in public hands, even a modest increase in demand from short sellers can quickly strain the supply of borrowable shares, driving the CTB through the roof. The extremely low, effectively zero, trading volume also contributes to this. When no shares are changing hands, it's virtually impossible for short sellers to locate and borrow shares, further constraining supply and pushing the CTB higher. Squeeze mechanics explained. Now, let's talk about the big one, the short squeeze. Here's how it works in plain language. Short sellers borrow shares and sell them, betting the price will fall. If, however, the price of the stock unexpectedly starts to rise, these short sellers begin to lose money. To limit their losses or close out their positions entirely, they must buy back the shares they initially sold. This buying pressure, in turn, pushes the stock price even higher, which then forces more short sellers to cover their positions, creating a rapid, compounding upward price movement that's a short squeeze. For GITS, with its 932.3% CTB, short sellers are not only feeling the pressure from potential price increases, but they are also bleeding money daily just to maintain their positions. This intense daily cost can act as a powerful catalyst, potentially forcing short sellers to cover even faster if the stock shows any upward momentum, thus fueling a squeeze. However, it's crucial to remember that a high CTB does not guarantee a squeeze. It can also indicate that short sellers have very strong conviction that the stock will eventually decline, and they are willing to pay a premium to maintain that bet. Dilution risk check. When evaluating a potential short squeeze, one critical factor we always examine is dilution risk. Dilution occurs when a company issues new shares, increasing the total number of outstanding shares. This can be a major headwind for a short squeeze thesis. For GITS, we found some good news here. There have been no recent diluted SEC filings like S-1s, S-3s, or 424Bs in the last 90 days. This means the company hasn't recently indicated plans to issue new shares that could flood the market. Why does this matter? Dilution can negatively impact a short squeeze for a few key reasons. It increases the overall supply of shares, which can absorb buying pressure and make it harder for the price to climb. It can also provide short sellers with an easy way to cover their positions by buying these newly issued shares, effectively negating the scarcity that drives high CTB and squeeze potential. So, for GITS, the absence of recent dilution risk is a positive, but it's only one piece of the puzzle. Before we continue, a quick reminder. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Given GITS' unique situation, a 932.3% CTB and a 2.4 million share float, but with zero trading volume, what should we be watching for? First and foremost, any increase in trading volume is absolutely critical. Without volume, the price remains stagnant and no short squeeze can even begin. Show GITS chart with no movement. A sudden influx of buying interest, especially on significant volume, could put pressure on short sellers. We then watch for sustained upward price action. Keep an eye on the cost to borrow as well. If it remains elevated or climbs even higher, it indicates continued pressure on shorts. Any news or corporate developments for GITS could act as a catalyst, shifting sentiment. However, it's important to reiterate that GITS' composite squeeze score of 42.5 out of 100, combined with its current lack of trading volume, suggests it's not an active squeeze candidate right now, despite the very high CTB. The high CTB signals intense pressure if the stock were to start moving, but without any movement or volume, that pressure remains theoretical. So, GITS serves as an excellent case study for understanding the extreme dynamics of hard-to-borrow stocks. With a staggering 932.3% annualized cost to borrow and a tiny 2.4 million share float, it highlights how scarce borrowable shares can become. While the absence of recent dilution risk is a positive, the current lack of trading volume for GITS means that any potential for a short squeeze remains dormant until buyers step in. Remember, a high CTB is just one indicator. It's the combination of factors, including volume and price action, that truly fuels a squeeze. Always do your own thorough research and understand all the risks involved before considering any investment. If you found this explanation helpful, please hit that like button, subscribe for more in-depth financial education, and let us know in the comments if there are any other hard-to-borrow stocks you'd like us to analyze.